And so before we get started, if you're interested in using the same broker that Mitch and I use, go check out TradeNet. They currently have a 30% off sale going on where you can get the intro account for only $350. And that's a huge deal because it comes with a funded account with $14,000 in buying power to trade with. There's also no PDT rule, and so new traders specifically can day trade as much as they want. And I think it's a much cheaper option for new traders when they first get started. The commissions are pretty cheap if you use small sizing. There's no PDT rule, and you're only risking what you pay for that account. And so it works like a prop firm, and if you want more information or if you're interested in checking that out, I'll include a link in the description. And so thanks for watching and enjoy this video. Alright, so like I said, today's class is we're looking at two different strategies. Today we're looking at the VWAP fade and the VWAP bounce. And then we also have what I call a hybrid of those two strategies. And like I said, I think that's relevant to talk about considering how well the VWAP fade has been performing in this market. At least with the stocks I've been watching, it's been performing extremely well. And it's one of the reasons I'm on this current 11-day win streak. And so, like I said, the breakdown of what today's class is going to be focusing on is it will be focusing on ideal risk-reward levels for my favorite strategies. Remember, risk-reward levels are subjective, and so you can find and test your own if you prefer. You don't necessarily have to use these type of levels. These are simply the levels that I have found work the best with these different strategies. And if we can... if you guys like this class, we can continue to do this type of class for different strategies. I know there's a lot of different strategies. Obviously, my favorite ones are obviously the VWAP fade and the VWAP bounce. I think those are honestly very high accuracy setups, very reliable setups in my opinion. And maybe I'm a little bit biased, but we can kind of break out and do other strategies in our next class if you guys want. We can do maybe one on the opening range breakout or the 1 minute range breakout. Another one that's been working well in this market that two-way may want to be a part of. I'll see if two-way wants to join us and talk a little bit in that class is the red to green move or the washout long, and we can kind of go over those and have a different class or a different class on a few different a few different instances of different strategies and where the ideal levels to set risk reward would be with those strategies. All right, and so the VWAP fade, when we're looking at risk here, this is one of the things that I think I do fairly well with the VWAP fade, and I'm not trying to compliment myself. I just think that I have a pretty good understanding of where the VWAP fade pulls back to, and its range when it does pull back. And I think that's just from trading it over and over and over again. But as we have talked about in a previous video, a favorable risk reward level for VWAP fades are the bottom range of the first few candles. Many times the first few candles will bottom out roughly at the same area, creating an obvious support and resistance level for long traders to exit and short traders to base off of. And so basically, whenever the level is extremely defined from those first few candles, all the other traders that are looking to trade that stock have noticed and acknowledged those levels, and that makes them even more valuable to you as a trader. Another way to approach this, if there has already been one fade on that particular day, the high of the first pullback or fade can then be used as risk. So the high of a previous pullback or fade can be used as risk as well, and that seems to work fairly well in my opinion too. This makes sense because if it breaks that level, it's essentially putting in a higher high, making it seem more bullish to others and hurting the downward momentum. And so I know that sounds a little bit confusing, and we can kind of look at exactly what I'm talking about here. All right, and so when I mean the bottom of that opening range, the bottom of those first few candles, this is a really good example of what I mean by that. If this bottom can happen roughly around the same area as the second or third candle, then it kind of gives it a very obvious support and resistance level to follow. And so we can look at this here. This bottom right here, you can see those two are roughly at the same area. One's a wick and the other one has actually wicked down a little bit. But this gives it a lot of weight in the market. People are definitely watching this level for that break. That's really probably the closest and most significant resistance level to this entry. And so if you're entering the stock here with the VWAP fade, you got a pretty tight risk reward if you're setting this level as your risk. And again, like this says, notice how the bottom of the opening candles are roughly at the same level. this shows other traders a very obvious level to watch and base their trades off of. And so, like I said in the previous slide, some long traders that are buying the panic dip, some long traders are, they're dip buying this. When they see this drop, they're buying it long. And a lot of times they're going to use this level as their reward target. They're going to use this level, or maybe, these previous levels here, maybe even the VWAP as their reward target. And so when they're going long here and they start to cover their positions up here, that usually causes this stock to drop. And if it does actually break this level, then that should be kind of like your cue to exit the trade. And it makes sense. Why? Is because short traders are also just like us in this VWAP fade, which is a short strategy. Short traders are watching this level as well and saying, okay, if it breaks that level, I have to get out of the trade. And long traders are panic buying the stock down here, and they're covering right around this area as well. And both of that is going to make the stock drop some. And so that should, again, if it does break this level, an alarm should go off in your head and say, okay, it's time to get out. But does everybody understand what I mean by this bottom range here of those first few candles? I think I see this, I really do see this support and resistance level over and over and over again. I've been trading VWAP fades for years now. And this is honestly one of the major levels that I always set my risk. Depending on where the VWAP is in relation to it, sometimes I will also use, let me draw this out. Sometimes I also use a level like this right here, depending on where the VWAP is. It's a little bit crooked. Let me see if I can draw it a little bit better. But sometimes I'll even use a level like this. It just depends on where the VWAP is in relation to it. We'll kind of go over this a little bit later. This is more for VWAP rejections. And most of the time with fades, you see this major level here. And so it's just a very obvious risk level that can, that you want to start watching if you do start to trade VWAP fades. Let's go over a few more examples here. And I know a lot of traders, they don't necessarily trade against me, but they trade, some of them trade against me, and that's fine, because either way, as long as you're waiting for your entry, that can work as well. A lot of traders are actually taking these type of positions. Let me see. A lot of traders are buying it long down here, and they're riding it up to the VWAP. And they're using the VWAP as an exit. And that's another reason why the VWAP works so well. The VWAP fade works so well is because some traders are riding it up to the VWAP. They're longing it. They're buying it down here. Which we've actually gone over in a previous class, the panic dip buy. Some traders are buying it down here where their circle is, and they're riding it up to the VWAP and they're selling it right around the VWAP. And that's also what causes, sometimes we'll have just instant green trades where we get in short right here and then it just immediately flushes down. And that's actually because panic dip buyers are buying it here and they're selling it at the VWAP. And so when everybody sells at once up here and they're using the VWAP as a reward target, it just makes the VWAP flush right back down. And it's great. I love those trades, but that's probably why, is because long traders are covering it at those levels. All right, here's another example. And like this says, you can also use this type of level to where the high and the low of the body kind of converge and meet together. And so in this case, it's kind of the low of the body right here and the high of this previous candle. And when these two meet, again, it just makes a very obvious risk level. One thing you want to get into the habit of when you're establishing risk levels in trading is you just want to look for, if you were in the opposing side of the trade, where would you want to buy? So like what I do with VWAP fades is, where would the long traders, if I was looking to go long on the same stock that I'm watching now, where would I want to buy? And one of the areas I would want to buy is when it starts to break this level here. Two-way always talks about it, about trying to get in before it pulls a red to green move, before it pulls a red to green move. And this is one of those big levels that a lot of other traders are watching. And with that, a lot of traders are going to start longing the stock here, and a lot of short traders are going to start covering their position. And both of those things can make the stock squeeze up, and I just don't want to get caught in a squeeze, and so it just makes sense to have this as your level. But, using these two convergence, like you can use the first two candles for a lot of different stuff with the fade, and watching them to see if they bottom out at the same area, or if they kind of converge like this, can give you a really nice risk level to base your trade off of. And with both of these, you can also see that it's pretty good risk reward. If you get in the stock, let me draw this a little bit better. If you get in the stock here and you set your risk up here and your rewards down here at the low of the day, your reward you're only risking this much. Hold on, you're only risking this much, but your reward is that much, and so your reward's just much bigger. And that's why I like taking the fade. Risk reward is usually spot on with these, and this is one of the ways I keep my risk tight, is using levels like this. And again, I've been trading the VWAP fade for years, and this is something that I tend to look at each time it happens. I see this extremely often in the market, is areas like this holding as resistance. And a lot of times you'll see me on the stream, it will go exactly up to my level, the risk level, and it'll kind of top out there and come right back down, confirming that level. And that's one of my favorite things as a trader, is when it confirms my level. It's a little nerve-wracking when it happens, but it definitely works pretty well. Alright, so I was talking about the first example, but it's pretty much clear as day here too. You just got to play it, I guess. Yeah, for sure. And it's one of those things, like, you'll see a lot of the time, one of the levels that is not my favorite risk level is the previous high of the day. And the previous high of the day, I can draw that out here with fades. It's extremely risky a lot of the time, because if you use this level up here as your risk, if it actually breaks that level, you know, worst case scenario can happen. And what I mean by worst case scenario is that if it breaks this level and it's a low float stock, it can really squeeze up, it can get halted, it can really just jump up extremely quickly. And so I try to never use the previous high of the day. And I've noticed that when I stop using the previous high of the day, I don't get squeezed out as much. Do I ever use the VWAP as your risk? No. Not, at least not for me. With the VWAP fade, it's the VWAP fade. I'm entering it at the VWAP, and so I'm entering it like my buy zone for VWAP fades is probably like right there. It's probably my buy zone. Like I'll get in down here. I may get in up there, but most of the time with fades, I'm probably getting in early. If it squeezes up too quick, I probably won't get in it. And so a lot of times I'll get in early, but I'll try not to get into it late. Although late, you know, I always talk about it. The closer you get into this stock, the closer you buy any stock or short any stock relative to the resistance level that you're using, the better your risk and reward is going to be. And so, like, obviously, if I shorted the stock here and set this as my risk, I'm going to have a pretty good risk-reward ratio. But I do think the accuracy rate is going to go down substantially when you do that as well. And here's another one. And this is one that's extremely common as well. And so here's the first fade right here. This is one fade right here. And this is a beautiful fade. I see these happen a ton. And when these happen, just to break it down, I usually use these levels here as my risk. So I'll draw this out so you can see what I mean. When these happen, I usually use the body low as my risk, or I try to. And so that's my risk. I can get in here, give myself a decent risk reward level down here somewhere, and it's pretty tight risk reward. But when I see a second fade, say I missed the first fade on that particular day, these work extremely well too. I can use the previous fade as my risk. You know, you enter it here, set this level down here as your reward target. You know, enter it here. You still got a pretty good almost 2-to-1 risk reward ratio, and I see these happen a lot as well. And so if you do have a pullback of some sort here, or another fade, if you have a fade or a pullback here, then you can use the high of that level as your risk. And like this says, also notice how the support and resistance levels, I must have mistyped this. Also notice how the support and resistance level I spoke about in the previous slide is relevant here as well. These levels show up time and time again with fades. So again, you see these two levels, this candle and this candle kind of converging right at the same area. And then you also see that's exactly where it got rejected here. And so just another very obvious risk level. And, you know, here's the thing though, guys, is that you can use previous days, you can use the daily chart to determine where your risk or reward is and stuff like that. But I've traded these for years, and honestly, just using the previous intraday chart and then using pre-market or after hours to confirm those levels works the best. It very obviously works the best. And so I'm not saying you should ignore pre-market or after hours, or I'm not saying you should ignore the previous few days. If the volume's not good enough in pre-market and the volume's not good enough, you know, then you can look back on the previous few days. But it just seems to work better when you're using intraday levels. And I think because when you attack the open, those most recent levels are the ones that are still in everybody's head, and they're the ones that other traders are looking at too. If that makes sense. All right, and the reward target, guys, at least for VWAP fades, this one's going to be really easy. The reward target is almost always going to be the previous low of the day or a more confirmed support or resistance level. Now, there's a few other things to look at with reward targets with these, but they're almost always going to be the previous low of the day, at least for me. The reason for that is because stocks move in ranges, and a lot of times they'll move in ranges in between the VWAP and the previous low of the day, and they'll kind of move back and forth between bounce down or come back down to that previous low of the day, bounce back up to the VWAP, get rejected back down, and come back down, and you'll see this happen all the time and over and over and over again with a lot of different stocks. Like this says, though, these can be half or whole dollars or just regular, highly confirmed levels. A big thing to understand with these, though, let me delete this. A big thing to understand with these is that you want to try to ignore these big, long wicks and try not to use those as your reward target. The reason being is because when you get a wick like that, it usually means some buying pressure, and it also means that it didn't actually maintain those levels for long. And so I think they're a little bit unrealistic of reward targets, especially if it's a really big, long wick and the body's much higher. I don't think that's a smart area to set your reward target as the bottom of the wicks. And so I'll show you what I mean by that in this next slide here. You can see the wicks down here. And so you can see all of these wicks down here, and you really want to just try to ignore those wicks. Like it says, notice how we ignore the wicks and try to find the low of the day area with the most confirmations. And so, we can use this wick here and these, but these really long wicks I'm ignoring because it's just not a reasonable, I don't have a reasonable expectation of if the stock hitting those levels and maintaining there. If it does hit those levels, it's going to be kind of tough, and you did get some confirmation here, but I think a lot of the times what you're going to see here, guys, is that you're going to see the stock pull this number. You're going to see the stock come down, and then it's going to bounce right back up, and then it may come down, and it actually starts to form a triangle, a descending triangle. And so let me erase this to show you exactly what I mean. You'll see it start to form. You'll see it kind of pull this number if I can draw it. You'll see it go up, down, get a tighter range, tighter range, tighter range, until it just breaks down on one side, and say the VWAP follows it down here. That's what you'll see a lot of the time with these, and so you do want to be on the lookout for that as well. But for that reason, that's why we set the previous low of the day as our reward target, is because you'll get that extremely often. If you get really good at trading fades, you can actually add back at the VWAP here when it does pull back there, and kind of add it, take profits at the low of the day. When it pulls back, add some more, take profits at the low of the day until it actually squeezes you out. And I know a lot of traders attack that route as well. All right, and so now let's move on to the second strategy, which is called the VWAP bounce. This is essentially the VWAP fade flipped upside down. And so this is a long strategy, and like this says, similar to the VWAP fade, the VWAP bounce risk level can be analyzed and set using the high of the first few candles or the opening range. I see this a lot as well. Just like before, this level is very self-evident to other traders, and they subsequently base their trades off of these levels. And that's why these levels work, is because other traders see them. You want to look for the most obvious levels and use those levels because that's what everybody else is watching. This gives them weight in the market, if you will, and makes them very significant to you. Still, not reflecting the VWAP fade, be careful using previous bounces as your risk in these type of trades. Just like the last one, sometimes you'll see pullbacks in previous fades, and you can use the high of those as your risk. With the VWAP bounce, I just don't think that works as well. It still works. I just don't think it necessarily works as well. The bounce being a bullish trend strategy, since the bounce is being a bullish trend strategy, it can get exhausted. It gets a little bit exhausted easier, and thus can fall quicker when switching trends. And so I hope that makes sense. Sorry, I kind of got tongue-tied there. But yeah, this being a long trade, I've always said, and I think I say it on an upcoming slide, I think that ultimately panic is a stronger emotion than hope. And I think that when you're trading these long strategies, a lot of the time they can pull back very, very quick. Sometimes you'll get this happening with short trades, and it just depends on the volume and the float and stuff like that. But I see this a little bit more often, at least with the stocks I trade with the VWAP bounces, that they can kind of very quickly turn against you, and you have to be prepared for that. And it's just my preference when trading it. All right, and so here's an example of one, And like you can see here, it says, just like in fades, looking for the best mix of highs can be a great risk and reward level. Other traders see and watch these levels, and so it makes sense to do so as well. And again, long wicks should be ignored a lot of the time. Not always, but with long wicks, if you can find a decent area where it's a wick and a body high like this, then that's probably a decent level. Let me see if I can draw that out here. This level might have worked as well. You just got to let it test, and you can see it actually broke that level. And so maybe it's my hindsight that stayed away. Maybe I would have picked that if I didn't know what happened. But this is a good example of it. And just like in the fade, you actually see, that convergence of those first few candles here. And you get the body mixed with the high wick, and you get some other confirmation there. And so with that convergence of those first few candles, you can then base a really nice VWAP bounce. And does everybody also see how how it's basically just the opposite of a VWAP fade? You get a bullish trend instead of a bearish trend. You get a nice bounce off the VWAP. So when I say body high chase, let me see if I can zoom in here. I think it'll let me zoom in. Hold on one second. So like, let me find an example. I'll try to zoom in. Hold on. All right. And so what I mean by that is, like, this would be a body high right here. So I'm talking about the candle excluding the wick. I'm talking about the body of the candle here, which would be this area here. And then the body high would be here. The body low would be here. Do you see that? Another example, body high would be here, here. Body low would be here. So I'm just saying excluding wicks. Yeah, no worries. I'm just saying excluding the wicks. All right. All right, and so let's look at the bounce reward target, and then we have some on-demand examples. So with bounce targets, trading the high of the day is a great way to target a high accuracy level. So you can use the high of the day just like the low of the day for VWAP fades. These levels are significant because of their relevance to other traders. And that's one of the reasons I typically like to set the previous high of the day or the previous low of the day, depending on whether I'm long or short, as my first reward target. And the reason for that is, like I said in a previous slide, stocks move in ranges a lot of the time, and with the VWAP being a trend indicator, the VWAP is an intraday trend indicator. And so, if the stock is going to maintain a downward trend, it's going to move up and down, back up to the VWAP. If it confirms the downward trend, it'll stay back down and move back down to the previous low of the day. And it'll kind of stay in that range a lot of the time. And you can add back when it pulls back and then sell when it reaches that low of the day. And, those low of the days turn into pretty significant levels when you're trading as well. Let me see if I can... Okay, it's in the next slide. So remember, long moves get exhausted easier, and so keep that in mind when trading in a long position. And this is just subjective. It's my opinion. I think long moves get exhausted easier. It may be because I'm biased as a short trader. But you do want to keep that in mind and just be prepared for, a squeeze down. And again, panic is a stronger emotion than hope. Unknown. I don't know who made that quote, but I definitely agree with it to a certain extent. All right. And then we have another good example of just using that exact same chart that we used previously. You can see the high of the day. And you can also see that's a major level here. Also notice how the previous high of the day created a major support and resistance level that the stock actually followed later on in the day. And so this is true for most stocks and levels. Previous highs and lows are subsequently watched for the near and distant future. So when you see a previous high or low break, a lot of times traders are looking for those levels to hold as support, but you can just see how much weight this level had. It bounced and rejected off of that level numerous times, and so once that does actually happen, it actually turns into a major level for the rest of the day. Yeah, I kind of do the same, Chase. If you hear me on stream, I kind of I'll get frustrated if a stock just kind of hangs out at a certain level, and but that's really if I'm getting too emotional, I know I'm not doing something right. You want to try to be like a robot in trading. You're never going to be. You're always going to have some emotion. I don't care what anybody says. You're always going to have a certain amount of emotion when you're in a trade, but you want to try to control it as much as possible. All right, and so that's it for that PowerPoint. And now let's look at some fun on-demand examples. All right, so I'll do a few just regular on-demand examples, and then we can have some fun and trade some random ones where I don't actually know what's going to happen. When you see these type of moves, you want to start calculating your risk and reward down here. You want to start calculating your risk reward when you see it here, at least with a fade. You don't want to actually be kind of on the you don't want to be rushed to do it. And one thing you'll see me do a lot of the times is I'll be really rushed. I'll spot a good fade and I'll actually miss the trade because I wasn't actually ready calculating risk reward and stuff like that. Because at this point, calculating risk reward is something I do in every single trade I get into. And I strongly suggest that any trader should be able to calculate risk reward in any trade they get into. I think it's really going to make an improvement not only with your trading, but in analyzing your trading as well. And I think it's one of the most underappreciated aspects of trading. I don't really see a lot of people talking about risk reward in the market. And so I think, like I said, I think it's one of the most underappreciated aspects of trading. And so with this, again, we have this level here, this $76 level. It makes a lot of sense because not only is it a whole dollar, but it also has some confirmation here. And like I said, we get kind of all of these levels, these three levels. We have the body mixed with the low, mixed with the wick low, and it just gives you a really nice risk and reward level. And, this is a level that most other people are going to be watching as well. And one of the things you want to get into the habit of doing is, even if the level is very obvious and significant, you also want to make sure you actually have good risk and reward levels. And so you want to make sure your ratio is good as well. And so in this case, we can use that previous low of the day right here at about 74.85. If we get in at 64, where the VWAP is, and at this point, we can use 76, the whole dollar, as our reward target. And so in this case, our reward target would be, or our risk is 35 cents. We'll just say 35 to make it even. It's really 36. But we'll make it 35 just to make it easy to calculate. So our risk is 35 cents up to 76. And then our reward level is roughly at the low of the day at 85. So our reward target is roughly 80 cents. And so our risk is 35 cents and our reward target is 80 cents. Is that better than 2 to 1? Yes. So it's slightly better than 2 to 1, and that will work. My mentality is as long as it's better than 2 to 1, I'll take it. Even if it's close to 2 to 1, I'll usually take it. And the reason for that is because sometimes, the accuracy rate goes down with the better risk and reward that you have. If you're looking for a 3 or 4 to 1, although that is ideal, sometimes it's a little bit unrealistic. It just depends on the trade and the stock and how much the stock's range is and stuff like that. And so, you want to have a reasonable risk and reward level. It doesn't need to be, of course, everybody wants to shoot for 5 or 6 or, whatever, 6 to 1 or whatever they want to do. But is that actually reasonable here? And because, for instance, if I shorted the stock right here, if my risk was 76 and I got in at 75.95 right here, and I said this level was my reward target, well, yeah, I'm going to have an incredible risk reward ratio. My risk reward is going to be like 100 to 1. But is it actually going to follow through and hold? I really doubt it is. And so you want to have a good mix of reliability, follow through, but also, reasonable expectations. And so anyways, with the VWAP fade, we have our risk level set. We have a reward level set. And at this point, we could just fast forward it. Another thing I always try to get into, and we've gone over this in our planning class about building a trading plan. What I typically like to do is I like to look at the range of the stock. At this point, the stock has a range of, we can mark the high and the low of the day. Let me do this really quick. And so I always like to look at the range of the stock. We can say the low of the day is at 74.80 and the high of the day is at 76.85. And so that is roughly what is that? $2.05. And so it's got about a $2.05 range. And so that's a pretty range, although it is a more expensive stock. And so with a big range like that, you want to have a reasonable, you don't want to take huge sizing. And the reason for that is because your risk is 35 cents and the stock has a pretty big range. And so if you take huge sizing, and you do get stopped out, you're going to take a bigger loss. And so you want to understand the range of the stock as well. A lot of traders will just try to use the same share size no matter what. But what they have to understand is that stocks have different ranges. A stock that has a $5 range and a stock that has a 50-cent range are going to give you much different results if you use 1,000 shares with both of them. And so you want to understand the range, and that's one of the bigger reasons why people have a hard time finding consistency and profitability, is because even if they may win more than they lose, if they win a bunch, but when they do lose, they're not analyzing the range and they're taking too big of sizing, then it's going to cause these big drawdowns in accounts. And that's ultimately that's a big hurdle traders face in actually being profitable. And I know this from experience. Okay, so let's see, it's got a big range. We'll just use 500 shares, make it easy. And again, you see these levels hold a lot. And one thing I do see a lot, especially if you're using this whole dollar, you also see this is the whole dollar of 76. One thing I try to do is I try to let it at least test the whole dollar. And so if it's a big range stock, I'll give it an extra 5 cents. And you're still going to have 2 to 1 or better in that if you do give it that extra 5 cents. Because a lot of times with these, you'll see it push up and then come right back down. And so I do let it test. That's subjective. I know Mitch doesn't let his test as much. And really, that's just up to preference. And again, the way I really like to approach them, the way you see me approach these a lot, is once it actually gets down to that low of the day, I take some off, and then I let the rest work. So we're in with 500 shares. I take 300 off, 3/5, and then let the rest work to see if it's actually going to come back down. And if it breaks, great. But if not, you take some more at the $0.50 when you're taking profits. Oh no, I actually shorted 800 shares. Here, we'll just do that. And now we have 200 left, and then you can take some off. You can let it test the $0.50, let that test, and then continue moving down. And now with reward targets, you don't want to just have this level set. Once it actually does break this level, what I like to do is I use $0.50 as my guide, mixed with a little bit of confirmation in the trade. And so I look back on the history of the chart, map out the major levels here, and see if those are relevant to my chart. If they are, great, and if not, I use half or whole dollars. And the reason I use half or whole dollars is because, again, you see this go exactly down to 74.50 and then bounce. And then if it breaks that, you can use the previous low of the day as your final risk area. Does that make sense? Does everybody follow what I mean by that? That once it breaks that previous low of the day with the fade, then you can use $0.50 as your next reward target if there's no other, previous levels that are recent in the chart. All right. And then again, if it does break this low of the day and you take some off at 74.50, you can just use this level, which was your previous reward target, as your risk, because previous support turns into resistance in technical analysis and vice versa. Exactly, Connor. Right. Letting the trend work for you after the target hits, and then using those previous reward targets as your risk once those levels actually break. And so that's a big habit you want to get into as a trader, at least one that I use, is that once those levels actually break, then you can use those previous levels as your risk. All right, and so here's what I would call a VWAP bounce setup. When you really start to look for VWAP bounces, you're just looking for an upward move at the open. And so you're looking for a big bullish move like that at the open. And in this situation here, what we're going to do is we're going to use, just like the VWAP fade, we're going to use those previous kind of convergence areas. In this case, we can use the two highs and the high of this one and then the body high right here. And that gives us a really obvious risk level. And you'll notice a trend here with the VWAP fade and bounce that we're using those first 5 candles the most when we're establishing where our risk is going to be in the trade. And so we can let this one work. And again, guys, if just based off of what we went over earlier, where would our reward target be in this situation? 42.10. Exactly. Perfect. That's right. That's right, Chase. It'd be exactly at this level right here, 42.10. It's not necessarily this wick high. It's kind of, you know, you get multiple confirmations. You see everything kind of come up to that level. It's still technically roughly the high of the day, but it's not this wick high because a lot of times, again, that can be unreasonable, and that kind of shows you there's some pressure up here. And so in this situation, we can use this area as a pretty tight risk level. And we can wait for the pullback here. And again, we can also get into the habit each time we're building a trading plan to analyze the range of the stock. In this situation, we have the low of the day here, and we have the high of the day up here at 42.10, or, you know, we can even use 42.15 if we want for this. And so that gives us a range. Let's see, 41.32. I'm just going to say 41.30. A lot of times when you're doing this on the fly, you're going to have to take a few shortcuts with calculating range and even risk and reward in some situations. And so one way I do this is I kind of round to the nearest 10. And so in this case, 41.30 up to 42.10. And so let's see, 41.30 up to 42.10 would be 80 cents. And so this stock has an 80-cent range on this particular day. And so if we get in at the VWAP at 75 and we set that 42.10 level as our reward target, then our reward target is roughly 35 cents. And that's a reasonable reward target. It's not even half of the daily range. And so we know that that reward target is reasonable. If the daily range was 80 cents and our reward target was 70 cents, we know that that reward target is going to be a little bit unreasonable. And that doesn't necessarily mean you can't take the trade, but you have to have that understanding that if it is that much and it's such a big percentage of the overall daily range, then you need to, one, scale out on the way some because it might be a little unreasonable to expect it to follow through completely, and two, maybe use a little bit smaller sizing with that. So yeah, so now we know our risk is good, we know our reward is good, and we can just take the trade at this point. And again, since this stock has an 80-cent range, you know, in the last one we took 500 shares, since this one is less than half of what the other one is, then we can scale up a little bit and use a little bit of sizing because again, you know, our reward target is smaller, our risk is smaller, and ultimately, you know, our risk and reward is both smaller, and so we can scale up and use a little bit larger sizing with this trade. Does that make sense to everybody? And that's kind of, if the stock has a big range, you know, you're going to have a bigger reward target, a bigger risk, and you can use a little bit larger sizing. Fast forward. All right, so here's roughly the low of the day. So at this point, you can scale out half of your position. And then where's the next reward target? Where would be a reasonable reward target from here? I was thinking you could probably use like this level here. I think this level has a lot of confirmation on the chart. You could use the next 42.50, $half right there would work as well. Or, you know, you could use, let's see, you could use 42.20 if you wanted to, or there's lots of other levels, but I think this level has the most confirmation, and it's ultimately probably one of the more reasonable levels. And that way, if it does break, you know, you can just use that previous high as your risk now. We'll just have to do a random one now. All right, so let's look at some stocks here. Let's look at my favorite stocks. So usually I get into a habit. Instead of looking on my watch list, I don't know if we have time for that. We will end up in this situation. I'll look at Cron, CGC. We can also use AMD. There we go. Sheesh. All right. Again, you have that convergence level, which is probably an unlucky number there. And we can just fast forward. Yeah, it doesn't look like we're going to have time to do it today. It'll be alright. Hey, it worked. And the low of the day was at 45, but we're going to just take half off here. And then we're going to let the rest work. See, even a year ago, fades were working on Cron. That's why I watch it every day.